Welcome to Geojit Spotlight. The Indian financial market had been performing exceptionally well for a long time. Then all of a sudden, the market got extremely turbulent. Geojit Financial Services Chief Investment Strategist Dr. Vijayaumar join us to explain the present market condition. Welcome, Dr. VK. The market have turned excessively volatile. Why this huge volatility?
Yes, the markets have turned excessively volatile. If you look at the performance of the market, this ongoing bull market from April 2020 onwards, you can find two distinct stages in this bull market. The first stage started from April 2020 and it ended in October 2021. This took the Nifty from the low of 7611 in March 2020 to a high of 18,604 in October 2021. Now, this was a unidirectional market. This was a one-way rally without any sharp corrections. This one-way rally, this happened in Wall Street as well as in Dalal Street. This one-way rally has ended in October 2021, and after that the markets have turned highly volatile. And this February onwards, 2022 February onwards, after the outbreak of the war in Ukraine, the markets have turned hugely volatile. And in recent days, we have been witnessing excessive volatility, like for example, in the mother market US, a 2% up move in one day, the 2% down move the next day, and again a 2% up move the third day. This is unprecedented. This kind of excessive volatility is due to the strong headwinds and strong downwinds that the market is experiencing now. Headwinds and tailwinds. The headwinds are the negative factors and the tailwinds are the positive factors. There are mainly three strong headwinds, negatives for the global markets now. The first is the American Central Bank's Fed's aggressive monetary tightening expected this year because of high inflation in the US. It is at a 40-year high. So the Fed is expected to raise rates by another 200 basis points in 2022, in addition to the 25 basis points hike that they did in March this year. So that is not favorable for equity markets, particularly when global growth is not very impressive. The second factor is the slowdown expected in China, because in China they are locking down the economy, locking down very severely, stringently. They have a zero COVID tolerance policy. Therefore, the severe lockdown started in Shanghai, now it is in Beijing. So this is expected to slow down the Chinese economic growth, which will have an impact on global growth also. The third factor is the war in Ukraine getting prolonged. Nobody expected the war to get this kind of, prolonged war. Nobody expected that. That during a war, a lot of unexpected things can happen. And commodity prices, particularly crude and other commodities also, prices are remaining elevated. So these are the challenges which the economy is facing, the markets are facing, the major headwinds. On the other side, there are tailwinds, the supporting factors, the positives. The positives are corporate results are good. Now the economy, global economy and the Indian economy particularly is on a strong rebound. And more important than all this is the retail investor enthusiasm. Retail investors are very enthusiastic about stock market investment, whether it is in the developed world or in developing economies like India. Retail is buying aggressively. The equity cult is catching up in a big way. So all down moves in the market, dips in the market are getting bought. And that is the reason why we are having excessive volatility in the market.
What should investors do in this volatile time?
Investors need not bother about the day-to-day volatility in the market. Long-term investors should focus on long-term investment and long-term returns. Investors should not be investing for 2022, 2023 or not even for 2024. They should have a longer time horizon of a minimum of 4 years. I would say investors should be investing for the year 2023, for 2030, for instance, that is some 8 years from now. By 2030, India will be an 8 trillion economy, and India's market cap is likely to be close to $10 trillion. That will be more than 3 times the market cap of the Indian stock market now. So that is going to be a great opportunity. Investors should be looking at this emerging opportunity and investing for the long term.
Dr. VK, which are the sectors that look attractive for investment?
Every year, certain sectors outperform. For this year, financial year 23, we expect financials to outperform most other sectors. The reason is there is a rebound in the economy, there is good credit demand growth, and if you look at the latest results of the leading banks, particularly the leading private sector banks, there is a clear increase in credit growth, and also there is a very good improvement in asset quality of banks. So when asset quality is improving and credit demand is increasing, that will be a dual benefit for the bottom line of financials. More importantly, financials are attractively valued now. Valuations are lower when compared to other sectors, mainly because FIIs have been major sellers in this segment. So that will be our top pick. Then IT is certainly attractive for investment, but IT valuations have been high. But then we had a correction in the IT valuations recently, particularly in the large caps. So after this correction in IT stocks look good for investment. Then there is the real estate sector. Real estate normally moves in a cycle. We had a up cycle in real estate from 2003 to 2030. Then from 2013 to 2020, it was more or less a stagnation. From 2020, it has picked up. So you can expect good performance from real estate and construction related stocks. On the flip side, FMCG is likely to be impacted, not in a big way, but since the edible oil prices have gone up, the crude oil prices have gone up, their input costs and also the packaging costs. When crude oil prices go up, the packaging costs increase, and when input costs like the cost of edible oils like sunflower oil, palm oil, etc. goes up, their cost of production increases. This will result in a pressure on margins for this segment. But ultimately, how individual FMCG companies will perform will depend on their pricing power. There are some FMCG companies which have pricing power and the ability to pass on the increased cost to consumers. They won't be affected. But there are segments where there is very high competition, and in those segments, the companies will not be in a position to pass on the entire cost. Therefore, margins will come under pressure. Therefore, the weightage for the segment can be lower. But generally, across industries, across sectors, there are high quality stocks, and dips in the market can be used for buying by the retail investors.